Hey traders, in this lesson, I'm going to be picking up where we left off in the breakout strategy lesson, so make sure to go back and watch that if you haven't already. And in this lesson, I'm going to be showing you how you can use a creative way to adapt the strategy tester system in our code to calculate our position size based on a percentage of our account balance. So for example, let's say we have a 10 pip stop loss on one trade and a 20 pip stop loss on another trade. We want to risk 1% of our account balance across both trades regardless of how far away our stop loss is. That's what I'll be showing you how to do in this lesson. Alright, so before we begin this lesson, I want to go over a few preliminary ideas and concepts so that we're all on the same page and we understand what we're doing here. So the first thing I want to mention is that the code I'm going to show you today is more geared towards Forex trading. The advanced position size calculation method I'm going to show you today is designed for Forex trading. I'm primarily a Forex trader, so that is my specialty. That's what I focus on the most, and that is what I'm most experienced with. However, in this lesson, I'm going to show you a few different techniques for calculating your position size on stocks and Forex. And if we have time, we'll go over futures and crypto, but I might split those off into their own lesson. But for now, before we begin today's lesson on this advanced method for calculating your position size as a percentage of your account balance while taking into consideration the exchange rate between your account currency and the currency you're trading. If I just lost you then, don't worry, I'll explain that in more detail in a little while. But before we get started, I just want to mention that I've already showed you a rudimentary way for calculating your position size as a percentage of your account balance with this line of code here in the RSI strategy lesson. But before we continue, I just want to break down the math behind this so that we're all on the same page and understand what we're doing here. For those of you who are proficient with mathematics, you probably want to skip the next few minutes, but for those of you who are like me and essentially mathematically dyslexic, I think it will be helpful to take a moment to just break down the math here so that we understand conceptually what we're doing when we use this method for calculating our position size. So if I bring up a calculator here, I'll break down what we're doing here. So first of all, this equation here, the first thing we need to do is calculate our risk per trade as a percentage. So if I scroll up here to the user inputs, here is our risk per trade input, and it is set to 1.0 by default. So what this math here is doing is converting our whole number risk per trade into a decimal number. So it looks something like this. A default value of 1% risk per trade. So 1 divided by 100 gives us 0.01. And if we multiply our account balance, our equity, by this number, we'll get our risk per trade as a dollar amount. So if we have a $100,000 account balance, and we multiply that by 0.01, we get 1,000, which is 1% of 100,000. This is the number we want to trade, meaning that if we get stopped out on our trade, we only want to lose a maximum of approximately $1,000. With stocks, there are all kinds of things that will affect this number, gaps, slippage, etc. But this is the number we want to use to calculate our position size. And to do this, what we need to do next is divide this number. So this code here gets this number. This gets our dollar risk per trade. And then we divide our dollar risk per trade by the spread between our entry price and our stop loss price. So for example, if we have a $100,000 account balance and we want to risk 1% of that account balance, that gives us a $1,000 amount of risk. And then let's say we enter our position at a stock that is priced at $100 and our stop loss is going to be at $80. Bear with my terrible childish drawings. So this gives us a spread of 20. So $20 between our buy price and our stop loss price. We then need to divide our risk per trade as a dollar amount by the spread between our entry price and our stop loss price. So in this case, that would be 1,000 divided by 20, which would give us 50. So 1,000 divided by 20 equals 50. That means that with that trade setup, entering at $100 with a stop loss at $80, we need to buy 50 shares. So in other words, this code here will work for stocks if you implement it into your scripts. Now, it won't take into consideration commission costs, slippage, spread, that sort of thing, but it is as accurate as we can get in terms of calculating our position size. Now, the reason we use the math.floor function on this value is, let's say we had $1,000 risk, but the spread between our buy and sell was 23.3. If I click equals now it's telling us to buy 42.91 shares, but most brokers will not allow you to buy a fraction of a share. So what we need to do is round this down, essentially. We don't want to round it up because then we're risking more than our 1%. Now, if this is a matter of preference, if you want to, you could round this up. But personally, I think it makes more sense to round this down so that maybe you're risking 0.99% instead of 1.01, 1.02%, etc. Hopefully that makes sense. So what the math.floor function does is it just gets rid of the decimals here, and it gives us the floor of this number as a whole number, as an integer. And so what this line of code here would do in this circumstance where we have these decimal numbers is it would just give us a position size of 42 shares. That's how this code here works. This line of code, these two lines of code here, these two lines of code here will be below the video so that you can copy and paste this into your scripts. It's exactly the same for short trades, except that we want our spread between our buy and sell stop loss to be a positive number. So in the case of a long trade, we need to subtract our stop loss from our entry price because we're entering long with a stop loss below our entry. If we're going short, we need to subtract our stop loss from our entry price because we're selling the market. Our entry price is here and our stop loss is above our entry price. So what that means is we need to subtract our stop loss from our entry price in the case of a short trade. And in the case of stocks, the entry price would be the opening of the next bar. Now, there is a problem when trading markets with large gaps, like stocks, where it's unlikely that you would create a strategy that enters on a closing price. Let's go out to a daily chart and look for a trade. You can see here that our trade is all messed up. We get our signal here. We enter short on the open of the next bar with our stop loss based on the signal bar, and our take profit is based on the signal bar as well. And because there was a gap here, we got entered at a terrible price and our take profit was inverse to our risk. Or in other words, we're risking a lot more than we're gaining when we win. This is something I'll cover in a separate lesson on stock trading strategies. If you haven't noticed by now, I'm primarily a Forex and crypto trader. And so I am learning how to create automated equity trading systems. But we'll cover equity trading systems in a future lesson. For now, I just want to keep things simple. We're going to focus on Forex, which does not typically have large gaps like this. If we go over to a Forex market, you can see here that we do not have gaps nearly as bad as most stocks. And so gaps aren't as much as an issue, especially if you trade through a market like Oanda, a broker like Oanda, which does not have any gaps in their price action, in their price data, because the gaps get filled by the bars that plot onto the chart, which makes it a lot easier to simulate backtesting. But we'll cover gaps in a future lesson. Today's lesson is about position sizing. As I mentioned, I'll leave the source code to this technique below. And in today's lesson, we're going to cover a more advanced technique, which calculates our position size while taking into account the currency conversion rate between our account currency and the market we're currently trading. So this is primarily for Forex traders, today's lesson. And let's get into it. Let's add code that will calculate a position size of 1% of our account balance per trade. Basically, what we are going to do is I'm going to copy in some code I've written for my automated strategies that calculates my position size. And I use this code to send my position size to a third-party API so that when my trades are executed on my broker, my position size is a percentage of my account balance. I already covered in the previous lesson, so go back and watch that if you haven't already, the RSI lesson. I already covered how this percentage of equity doesn't do what you think it might, with Forex at least. This is buying 1% of British pound versus yen, regardless of our stop loss distance, which is not what we want. If I click OK here, you can see that our equity, all the way here on our last trade, let me change my risk reward back to 1-to-1. All the way here on our last trade, we've only made $58 because we are not trading 1% of our account balance per trade worth of risk. We are just buying $1,000 worth of pound yen. And however much money that makes us is however much it makes us. 731 contracts is not even close to a mini lot, let alone a standard lot. And with a $100,000 account, we should be trading several standard lots per trade. So let's fix that right now. I'm going to copy over all of this code I've written. Don't freak out when you see it. It is a bit more complicated than anything we've covered so far. I'm going to paste it in here. and I'll break down what each line of code is doing. So you should be able to copy this code into any script you write, and you don't really need to understand what it's doing, but I'll still try to explain it as best I can so that you understand what's happening here. When you are calculating a position size, you need to take into account the exchange rate of the market you're trading, so pound yen, and the exchange rate of your account currency. So I'm on a paper trading account here with US dollars. So I need to compare the US dollar exchange rate to the pound yen exchange rate when calculating my position size. Now, if we were on US yen, the formula would be different because my account currency would be included in the ticker. If we jump over to US yen really quickly, now my position size is completely different because my account currency is included in the exchange rate of the market we're trading. But on pound yen, it's not included. So we need to convert our position size based on US dollars. But before we can do that, we need to know, is our account currency the same as the counter currency, which is what this check here does? It says, is strategy.account currency equal to siminfo.currency, which is this ticker here. And strategy.account currency is, this setting here. So if I set this to Aussie dollars, then strategy.currency would be, strategy.account currency would return AUD, but we've set it to USD. And because USD is not equal to JPY, this will be set to false. Our account is not the same as the counter currency. Next up, we check, is my account currency the same as the base currency? So is my strategy.account currency equal to the siminfo.base currency, which is the first ticker here? That is also false. So neither of these are true. My account currency is not the same as the counter currency, and it is not the same as the base currency. So next we check, is my account currency neither of these? So this will be only set to true if not account same as counter currency, so this is false, and not account same as base currency, so this is also false. On this particular market, pound yen, this variable here would be true. Our account currency is neither of these currencies. So once we have that information and we know how our account currency relates to the market we're trading, we can then check or get our currency conversion rates if applicable. So the next thing we need to do is generate our conversion currency pair. The way we do that is first we check, is our account currency the same as the counter currency? If so, then we can just return our ticker ID, because that is the exchange rate we want to reference when calculating our position size. So for example, if I went over to pound dollar, now USD is the same as my account currency, USD, which I've set up in the properties tab here. USD is my base currency for my account. And so we can safely just return this ticker. And when we calculate our position size, we're just using the pound dollar exchange rate. However, if we're on pound yen, now things are a little bit different. And basically, actually, I can get rid of some of this code here because this is redundant. But basically, if our account currency is not the same as the counter currency, then we return this, which will build our strategy.account currency plus the siminfo.counter currency. So in this case, that would build a ticker that looked like this. It would be our account currency, US dollars, plus the quote currency, JPY. Now we're getting the conversion rate of US yen. And then we use that exchange rate to calculate the appropriate position size for pound yen. The way we do that is we need to then get our currency conversion rate. So we use the security function here. If our account currency is the same as the base currency, or our account currency is neither of these currencies, then we use the request.security function to retrieve the current exchange rate, the closing price of our conversion currency pair on the daily chart. Then we also ignore invalid symbols. That stops our script from crashing if we load this on a market that's not compatible with this code. For example, something like Ethereum versus some random altcoin. That's not going to work with the strategy tester because we cannot select altcoins from this list. This code will work with some Bitcoin pairs, but it won't work with altcoins. And so if we load this script onto a market that is not compatible with, it will crash unless we set this to true. This way, if we set this to true, the script will continue to run and we'll still get some information here. We can still export our data and do some extra manual analysis of the data without the script crashing. Anyway, the next thing we do here is we display the current conversion currency, this should say ticker, for debug purposes. And in fact, let's add the exchange rate to this text as well. So to do that, I need to use the str.toString function and pass in our conversion currency rate. So now when I save my script, we're going to be generating a table on the last confirmed historical bar that will display our conversion currency pair and the current rate for that currency pair for debug purposes, so that we can make sure that the script is accurately generating the right exchange rate. If I save my code here, we should now be getting a table in the top right. Perfect. If we jump over to US yen, let's confirm that the exchange rate is accurate, and it is close enough. This is referencing the previous day's exchange rate, which was around here somewhere, which was 114.607. So that's okay. It's close enough. Let's jump back over to pound yen and open up the code. So that is our code for determining the exchange rate that we need to use in order to calculate our position size. Again, I'll cover this in more detail in its own lesson, so don't worry if this was confusing. It took me quite a while to work out how to do this myself. But all you need to know is that this code will work, at least on Forex pairs, especially on Forex pairs. It works perfectly fine. And what we can do now is I can use my Zen library. If I import my Zen library, I'll just paste this code in to save time. You'll notice that the version now is 3. In the previous lessons, it was 2. I did update it recently with a few minor changes, nothing significant. But if you want to know what I changed, there is a lesson earlier on in the course called Zen Library Update number 2 that will explain what is different in this iteration of my Zen library script. But now if I scroll down to where we enter our positions, I can create a new variable here. I'll create it under where we calculate our stops and targets, and I'll call this position size. And this will be set to zen.control space AV_get position size. So AV stands for auto view. I use this code for my auto view automation when I'm automating my scripts through auto view. That's why it starts with AV. But this will work on the strategy tester for today's purposes. So if I click on that, this function takes several parameters. The first is our account balance. So I can pass in here strategy.equity. The second parameter is our risk per trade. The third parameter is our long stop distance in points, and it needs to be a whole number. So I can write here zen.toWhole long stop distance, and then I need to multiply that by 10 in order to convert this distance into points. And then finally, the last parameter this function takes is our conversion currency rate, which is this variable here that we calculated up here. So I can copy this variable into our position size, close that parentheses off, and now we are calculating our position size for long trades based on our stop loss distance, our account balance, and a risk per trade as a percentage of our account balance, and that position size will be converted into the correct currency amount. This step is important for certain currency pairs because the position size on something like pound yen will be very different to something like Aussie dollar. All right, so now to use this position size, we need to specify the QTY parameter in the entry function. That stands for quantity. So QTY equals position size, comma. Now we should be calculating an accurate percentage of our account balance based on this setting here and our account balance here per trade, depending on how far away our stop loss is. So now I can copy this position size code into our bearish trades. I'll also copy the stop loss label text into here. I need to change this to short and this to short. Now we are accurately calculating our position size for short trades based on our short stop loss distance and our stop loss label text for short trades, the distance in pips. So I can add a comment on the end here that says short in brackets stop loss equals, and then I'll just copy this code up here, stop loss label text, and I'll throw in our position size code QTY equals position size, whoops, comma. Now when I save my code, fingers crossed, I didn't make any mistakes here. There we go. And now we are getting something very different. Our equity is significantly improved. That's about a 22% return. If we open up the strategy tester, we have a 23% return and a 6% max drawdown. And if I open up my list of trades, our position size is much, much closer to 1% per trade. Now, the position size will not be 100% accurate because there are some factors that will slightly influence how we calculate our position size, such as the exchange rate being a little bit delayed. It's getting the exchange rate from yesterday for our account currency, but it's good enough. It's close enough for us to get an idea of whether or not a strategy is profitable. Now, it's not a way to cheat out of doing the work of proper backtesting. You still need to manually confirm these results. You still need to do a bit of spreadsheeting, do a bit of confirmation, go back over these trades, make sure that everything adds up and that your script is performing properly and not doing anything obviously wrong. Or in other words, make sure there are no bugs in your script. But we are basically calculating 1% per trade on the strategy tester now. So check this out. If I throw on my profit tool here and I apply the right settings here, the right inputs. So our entry price was 156,733. Our stop loss is 156,565 and our target is 156,901. Now, if I open up my paper trading account and I reset my account balance to whatever our finalized equity is here, which is $122,186. If I click reset here, now my account equity is set to the same as what we see on our chart here. Now, if I right click my profit tool and create a limit order and we risk 1% of my account, I'll bring this over. You can see that our position size in units is very, very close. So 832,958, 832,620. It is off by a little bit, a very, very little bit, but a very, very little bit. I don't know if that's the correct terminology, but let me show you. If I change this position size to what you see on your chart here, which is 832,620, that's still 1% of our account balance. At this point, a couple of hundred units on 8 standard lots is not a big discrepancy. This is probably explained by the exchange rate being a bit delayed from yesterday. So the closing price of yesterday was around here somewhere. So we're off by a fraction of a percent, but that's okay. When it comes to the strategy tester, nothing is going to be perfect. You need to keep that in mind when working with your scripts. It's impossible to have a perfect representation of how your script would have performed. This is all theoretical. It's all just to help you get an idea of what ideas are worth pursuing further. So that is pretty much it for our script. I don't want to go into too much more information in this lesson. We'll cover some more advanced concepts in future lessons. This one is already long enough, but the whole point of making this script calculate its position size a little bit more accurately, even though it's not 100% accurate, is so that we can quickly cycle through markets and see which pairs perform with promise with this strategy. So you can see that this pair, Aussie CAD, with a 1-to-1 risk-reward profile at least, is nowhere near profitable. And it's the same with most of these pairs. If I cycle through these pairs, most of them are not profitable with this strategy. A couple of them are. CAD Yen is not bad. It has a 58% win rate, 39% return with a 5% max drawdown, which means we could easily bump up our risk per trade here and still have a reasonable drawdown. 11% is not an unreasonable drawdown for a theoretical close to 90% return over 196 trades. This strategy is best traded on the 15-minute chart, at least according to my testing, on a couple of these pairs. If you tweak the risk-reward profile and the stop-loss multiplier, you can get some different results. Depending on the market you're trading, you may be able to make this script profitable on other markets as well by extending or contracting the stop-loss. So having a half ATR stop-loss increased our return, but also increased our drawdown. I'll leave you to play around with that stuff. And in the next lesson, we will build on the concepts we learned here. Before I wrap this up, of course, the source code will be below if you want to play around with this. But one thing I forgot to mention is that the source code for the position size calculation is in my Zen library script code here. I explain what this function does in my Zen library lesson. So if you haven't watched those lessons, make sure to go back and watch them. Basically, it just takes those parameters that we give it and it calculates a position size by dividing our account balance by first calculating the risk amount by multiplying our account balance by our risk per trade, and then multiplying that by the conversion rate of the currency pairs that we're trying to trade versus our account balance denomination. Then we calculate how much risk we are taking per point. Then we are dividing our risk amount by our risk per point by the symbol's minimum tick, and then rounding that number, that value, to get our position size. If you wanted to, you could copy this function out and throw it into this code here. You might want to throw it underneath our conversion currency code here. Get rid of the float data types from those parameter names. And then if you also copy out my to-hole function into this script, you can get rid of my Zen library import altogether, and you have a standalone script that will do exactly the same thing as this script does that I just wrote and showed you guys. Anyway, my brain's starting to hurt now. This lesson is a lot longer than I hoped it would be, but there is a lot of information to cover here. The good news is, as we progress into future lessons, we shouldn't need to go into as much detail about these concepts since we've already covered them now. And so we should be able to knock out the next few strategy scripts without nearly as much explanation involved. And by the end of the course, we should have several scripts trading several different styles of approaches to exploiting edges over the markets. And I hope you guys enjoyed this lesson, and I hope you guys will enjoy the ones to come. I'll speak with you there. Take care.